Hey there, fellow investors. Welcome back to Insider Financial, your go-to source for all things finance and investing. I'm Alex Carlson, and today we're diving into one of the most exhilarating phenomena in the stock market, the short squeeze. Short squeezes, the roller coaster rides of the stock market. They're like the adrenaline shots that can send stock prices soaring, catching everyone off guard. But how does it all happen? Let's break down the anatomy of a short squeeze. But before we dive in, to get our market moving reports on top small caps, click that link in the description or go to signup.insiderfinancial.com or sign up with your email on any of the pop-ups on insiderfinancial.com. All right, let's get started on unraveling the mysteries of short squeezes. First up, we'll explore what exactly a short squeeze is and why it can turn the stock market upside down. Then we'll dissect the crucial components of a short squeeze, giving you a clear understanding of the forces at play. And of course, we won't leave you hanging. Stick around for tips on how you might navigate and even profit from these thrilling market events. Are you ready to uncover the secrets of short squeezes? Let me know in the comments if you've ever experienced the excitement of a short squeeze, and don't hesitate to share your thoughts throughout the video. Now let's jump into the fascinating world of short squeezes right here on insiderfinancial.com. A short squeeze in the stock market is a phenomenon where a sharp increase in the price of a stock forces short sellers to cover their positions, resulting in additional upward pressure on the stock's price. To understand the anatomy of a short squeeze, let's break down the key components and the steps involved. Number one is short selling. Short selling is a trading strategy where an investor borrows shares of a stock and sells them with the expectation that the stock's price will decline. The short seller aims to buy back the shares later at a lower price, returning them to the lender and profiting from the price difference. Second is high short interest. A short squeeze typically occurs when a stock has a high level of short interest, meaning a significant percentage of its available shares have been sold short. If the stock price starts to rise, short sellers may face mounting losses and may need to cover their positions to limit further losses. And you can get this right on finviz.com. This is Beyond Meat, BYND, and you can see 43% of the float is short, and it's all that data is on for every stock on Finviz, Nasdaq and NYSE. OTC is a little bit harder to find. Number three is a rising stock price. An external event, positive news, or a sudden change in market sentiment can trigger a rapid increase in the stock's price. As the stock price rises, short sellers may face margin calls, which require them to deposit additional funds to cover potential losses or close out their positions. Just because a stock has a high short interest, that doesn't mean the stock is going to move. It needs a catalyst. It needs things to make the stock go higher. Case in point is BYND, 43% of the float is short. The stock is down from $2.20 to $6.68 on Friday's close. That tells you the shorts have made a lot of money. And without a catalyst, that's why it doesn't pay to just go and buy any stock with just a high short interest. Number four is force covering. As the stock price continues to rise, short sellers may become increasingly pressured to cover their positions to limit losses. Short covering involves buying back the shares that were initially borrowed and sold short, contributing to the upward momentum in the stock's price. And you can see these past short squeezes happen in Gamestop. That was the most famous one. AMC APE. We also saw with DWAC, Digital World Acquisition Corp. This is the Spac that's merging with Trump's True Social. VinFast Auto, this is the Vietnamese EV maker. So we've seen a lot of major short squeezes in the past. Number five is the feedback loop. The buying activity from short sellers covering their positions can create a feedback loop, driving the stock price even higher. As the stock price rises, more short sellers may be forced to cover their positions, further fueling the upward momentum. Number 6 is liquidity issues. In a short squeeze, liquidity can become a challenge. Rapid and substantial price increases may lead to difficulties in finding sellers willing to sell at the prevailing market price. This lack of liquidity can exacerbate the upward movement in the stock price. Number 7 is volatility. Short squeezes are often characterized by high volatility as market participants react to the rapidly changing dynamics. Traders and investors may enter or exit positions quickly, contributing to sharp price swings. 8. Squeeze resolution. The short squeeze typically resolves when the buying pressure subsides. Short sellers have covered their positions or the stock experiences a pullback. The resolution may result in a sharp decline in the stock price as the temporary imbalance between buyers and sellers corrects itself. It's important to note that short squeezes can be risky, and the market dynamics can change rapidly. Investors should exercise caution and conduct thorough research before participating in or reacting to such events. Next up is how to profit in a short squeeze. Profiting from a short squeeze involves taking advantage of the rapid increase in a stock's price as short sellers cover their positions. However, it's important to note that short squeezes can be highly volatile and risky, and timing is crucial. Here are some strategies that investors may consider when looking to profit from a short squeeze. Number 1, identify potential candidates. Look for stocks with a high short interest, as these are more likely to experience a short squeeze if positive catalysts emerge. Monitor social media, financial news, and other sources for information that can trigger a short squeeze. Here on finviz.com, I have my short squeeze screen. The float short, I'm looking for high percentage of the float is short, over 20%. And then I'm using the signal top gainers. So these are stocks that are running that have high short interest positions. So you can see SKIN, TWST, MCRB. And again, these are all momentum plays. So if you look at this, when these start squeezing, almost all of these are green candles. So that is the key to focus on. You don't want to be dip buying short squeeze plays. You want to be focusing on the momentum, looking for breakouts, and trading accordingly. And number 2, that leads us to number 2, technical analysis. Use technical analysis to identify potential entry points. Look for bullish chart patterns, strong trends, or breakout points that could attract buying interest. Number 3 is risk management. Set clear risk management strategies, including stop-loss orders, to limit potential losses. Given the volatility of short squeezes, it's essential to have a well-defined exit strategy in place. Number 4, stay informed. Stay updated on news and events that may impact the stock. Positive news or developments can contribute to the momentum of a short squeeze. Number 5 is options trading. Consider using options to leverage your position or to manage risk. Calls or call spreads can allow you to benefit from upward price movements with limited risk. Number 6, monitor short interest data. Regularly check short interest data to gauge the level of short interest in a particular stock. A decreasing short interest may indicate that the squeeze is losing momentum, while high short interest suggests potential for a squeeze. Number 7, be cautious of overvalued stocks. Be mindful of valuation metrics. While short squeezes can drive prices higher, it's important to assess whether the stock's fundamentals supports its current price. And if you look at these past short squeezes, you got the squeeze, but then they all eventually corrected. So that is very, very important to know that eventually, that couldn't be the case, that, you get the major short squeeze and then you get a major correction and then you end up being a bag holder. So a lot of people, particularly on Gamestop and AMC, they came back into the stock thinking that a squeeze was going to happen again, and they never got it. Number 8 is quick execution. Given the fast-paced nature of short squeezes, be prepared to execute trades quickly when the opportunity arises. Number 9, diversification. Diversify your portfolio to spread risk. Don't concentrate all your resources on a single short squeeze candidate. Number 10, contrarian approach. Consider taking a contrarian approach by looking for stocks that have been heavily shorted and have potential for positive news or a turnaround. Again, the high short interest, but there needs to be that catalyst, which is news, turnaround, new CEO, etc. That's what really is it needs a spark to really get the rally started. Number 11, avoid chasing the rally. Be cautious about chasing a stock that has already experienced a significant price increase. Late entries can be risky and the stock may be prone to a sharp reversal, and that's when you become a bag holder, and that is the last thing you want to become. Number 12, monitoring market sentiment. Pay attention to market sentiment and trader sentiment indicators. These can provide insights into the psychology of market participants. StockTwits is a great resource. It gives you the sentiment, message volume, and then also put call ratio. Are more calls being bought or more puts? That can create the gamma squeeze like that we saw in Gamestop and AMC. What a gamma squeeze is that a lot of call buying forces the market makers, or the ones that sold the options to you, they have to go in and buy the stock to hedge themselves. So that's what really happening in GameStop and AMC. We got that gamma squeeze. So you got short covering, retail buying, and then the call buying forced dealers to hedge and go into the market and buy the stock. And guys, always remember that trading in short squeezes involves risks, and markets can be unpredictable. It's crucial to conduct thorough research, stay informed, and be prepared for sudden and substantial price movements. Additionally, consider consulting with a financial advisor before making any significant investment decisions. The stock market is a dynamic and ever-changing landscape, and understanding these market phenomena can be a game changer for your investment journey. If you have any questions or topics you'd like us to cover in future videos, let me know in the comments below. I love hearing from you. Thanks for joining me today on InsiderFinancial.com. Make sure to hit that subscribe button and ring the notification bell so that you never miss out on the latest insights and strategies. Until next time, happy investing, and may your portfolios be ever in your favor. This is Alex Carlson signing off.